Ever wondered why understanding the nuts and bolts of money and banking is crucial? It's not just about dollar bills and bank accounts. It's about how our entire economic system is structured and functions. So let's start at the beginning by unpacking the definition, functions, and characteristics of money. Money, in its simplest form, is anything that people are willing to use to represent systematically the value of other things for the purpose of exchanging goods and services. It's not just about coins and banknotes. It's anything that serves as a medium of exchange, a unit of account, and a store of value. As a medium of exchange, money makes trade possible by overcoming the limitations of barter system, where goods and services had to be exchanged directly for other goods and services. Money, in contrast, is universally accepted in exchange for goods and services, making trade seamless and efficient. Money also serves as a unit of account. It provides a standardized measure of value which simplifies the process of comparing and pricing goods and services. Imagine if we had to price a car in terms of chickens or apples. It would be quite a chaotic marketplace, wouldn't it? Lastly, money is a store of value. It allows us to save and accumulate wealth over time. Without money, saving and lending would be much more difficult, as goods and services cannot be stored or delayed for future use like money can. Now, let's talk about money supply. This refers to the total amount of monetary assets available in a country at a specific time. It includes things like cash, bank deposits, and bonds. Understanding the money supply is important because it impacts inflation, interest rates, and economic growth. With a strong grasp of what money is and how it works, we can now delve into the more complex aspects of the financial world. Stay tuned as we unravel the intricacies of the quantity theory of money, the functions of commercial banks, and the causes of changes in the money supply in an open economy. Have you ever heard about the quantity theory of money? This is a key concept in economics that helps us understand the relationship between the supply of money and the level of prices in an economy. Let's break this theory down, shall we? Imagine an economy as a giant marketplace. All the goods and services produced in this marketplace are bought and sold, and the money used in these transactions changes hands multiple times. The quantity theory of money is represented by this simple equation: MV equals PT. Let's start with M, which represents the money supply. This is the total amount of money available in the economy at a given time. It includes not just the physical cash in circulation, but also the digital money in our bank accounts. Next, we have V, the velocity of money. This is the speed at which money changes hands. If you think about it, each dollar in your pocket could be used to buy a cup of coffee, then that same dollar could be used by the coffee shop to buy milk, and so on. The velocity of money measures how many times a single unit of currency is used to purchase goods and services within a given time period. On the other side of the equation, we have P, which stands for price level. This is the average price of goods and services in the economy. Lastly, T represents the transaction volume, or the total number of transactions taking place in the economy. So, according to the quantity theory of money, the amount of money in the economy and the speed at which it circulates equals the total spending in the economy. In essence, this theory shows that if the supply of money in the economy increases faster than the volume of transactions, the result is inflation, or a general rise in prices. Conversely, if the money supply grows slower than the volume of transactions, this could lead to deflation, or a general decrease in prices. Understanding this theory is a stepping stone to grasping the broader economic dynamics at play. So, how do commercial banks fit into all this? Well, commercial banks are the lifeblood of our economy. They perform various functions that are crucial to the healthy functioning of our financial system. Let's dive into some of these roles. Firstly, commercial banks provide different types of deposit accounts. These include demand deposit accounts, which are essentially your everyday checking accounts, and savings accounts, which are designed to encourage long-term savings. These accounts not only safeguard our hard-earned money, but also enable us to conduct transactions conveniently. Commercial banks are also our go-to places for borrowing money, whether we need an overdraft, a short-term facility to cover unexpected expenses, or a loan for longer-term needs like buying a car or a house. Commercial banks are there to assist us. By lending money, banks play a vital role in stimulating economic growth, as it allows consumers and businesses to invest and spend, thereby driving demand and production. But that's not all. Commercial banks also act as custodians of various financial instruments. They hold or provide cash, securities, loans, deposits, and equity. These activities are integral to the functioning of financial markets and the broader economy. Now, while carrying out these functions, commercial banks aim to strike a balance between three key objectives: liquidity, security, and profitability. Liquidity ensures that banks have enough cash or liquid assets to meet the withdrawal demands of their customers. Security is about minimizing risks and safeguarding customers' deposits. And profitability, well, that's the end game for any business, isn't it? So by providing deposit accounts, lending money, and holding or providing various financial instruments, commercial banks play a critical role in our economy. They facilitate the flow of money, enabling transactions, stimulating growth, and maintaining financial stability. As we can see, commercial banks are instrumental in maintaining the economy's equilibrium. What causes changes in the money supply in an open economy? This question brings us to the exciting world of money supply dynamics, where a few key players and processes take center stage. Let's start with commercial banks. They are the primary sources of credit creation, thanks to the bank credit multiplier. In simple terms, when a bank gives out a loan, it essentially creates new money. This is because the money that is lent out is then deposited back into banks, allowing them to lend out even more money. This cycle continues, leading to an increase in the overall money supply. Next, we have the central bank, the grand overseer of a country's monetary policy. Through its actions, it can increase or decrease the money supply. For instance, it may buy government bonds to inject money into the economy, or sell bonds to pull money out. It can also adjust the reserve ratio, effectively controlling how much money commercial banks can create. Government deficit financing is another key player. When a government spends more than it earns, it borrows money, often by issuing bonds. This process increases the money supply as the government injects this borrowed money into the economy. Then there's quantitative easing, a rather unconventional method used by central banks. This involves buying long-term securities from the open market to increase the money supply and encourage lending and investment. It's like a shot of adrenaline to a sluggish economy. Finally, changes in the balance of payments can also affect the money supply. Suppose a country exports more than it imports. In that case, there will be an influx of foreign currency, which can increase the domestic money supply when exchanged. So, as you can see, several factors can cause changes in the money supply in an open economy. From commercial banks to central banks, government deficit financing to quantitative easing, and changes in the balance of payments. These factors collectively contribute to the dynamic nature of an economy's money supply. How can we manage inflation, and what drives the demand for money? Let's dive in. Inflation, a general increase in prices and fall in the purchasing value of money, can be managed through various policies. Monetary policy, for instance, is a key tool. By adjusting the money supply, central banks can influence inflation. If prices are rising too quickly, a central bank might reduce the money supply, making borrowing more expensive and slowing economic activity. Another policy is fiscal policy, where the government adjusts its spending levels and tax rates to monitor and influence a nation's economy. A government could curb inflation by reducing spending or raising taxes, which would decrease the amount of money in circulation. But how effective are these policies? Their success varies. The timing, magnitude, and economic context all matter. For example, if a central bank responds too slowly to signs of inflation, its efforts to tighten the money supply may arrive too late. Therefore, managing inflation is a delicate balancing act. Now, let's shift gears and talk about the demand for money. Here, we'll introduce the concept of the liquidity preference theory, proposed by John Maynard Keynes. This theory suggests that people prefer to hold their assets as cash, depending on the interest rates. When interest rates are low, people are more likely to hold money in cash since the opportunity cost of holding cash, rather than investing, is low. Conversely, when interest rates rise, People prefer to invest rather than hold cash. Lastly, let's touch on interest rate determination. Two theories come into play here: the loanable funds theory and the Keynesian theory. The loanable funds theory suggests that interest rates are determined by the supply and demand for loanable funds, while the Keynesian theory proposes that interest rates are influenced by the supply and demand for money. With these tools, governments and central banks can guide economies towards stability and growth. Understanding these principles is crucial to navigating the complex world of economics and finance.